Today's analysis requires your complete attention. We're examining a development in monetary policy that fundamentally restructures our understanding of precious metals markets. The date is Monday, January 19th, 2026, and a critical policy announcement from Washington has created conditions that demand immediate educational review. Welcome to today's market breakdown. Current data shows silver's paper trading price near $93 per ounce, while Shanghai's physical premium has reached $170. Many analysts are focusing exclusively on this $12 geographical spread. However, this price differential represents merely a symptom of deeper structural issues we need to examine. The primary development demanding our attention involves a new market participant, whose entry fundamentally alters supply-demand dynamics. Historically, we've tracked major silver accumulation by institutions like J.P. Morgan, sovereign entities including China's government agencies, and significant private demand from regions like India. Each of these participants operates within traditional market constraints. Today's announcement introduces a participant operating under completely different rules. Let's examine the specifics. Recent defense appropriations legislation contains language authorizing a $2.5 billion acquisition program targeting critical minerals for strategic national reserves. Silver occupies a priority position on this procurement list. This figure requires context within the physical silver market's actual scale. While $2.5 billion appears modest compared to broader federal expenditures, its impact on physical silver markets tells a different story. Annual investment-grade silver production globally represents a relatively constrained supply. At current valuation, this appropriation could absorb a substantial percentage of immediately available registered inventory. The critical distinction here involves procurement mandates versus market-driven purchasing. Private sector buyers operate within price sensitivity parameters. Hedge funds establish purchase limits. When prices exceed predetermined thresholds, buying activity ceases. Risk management protocols govern institutional behavior. Government procurement for national security infrastructure operates fundamentally differently. Price elasticity becomes irrelevant when acquiring materials classified as strategic necessities. Whether silver trades at $90, $150, or $500 per ounce, procurement mandates require fulfillment. Military guidance systems, satellite technologies, and renewable energy infrastructure all depend on silver's unique conductive properties. Without adequate reserves, critical defense and energy programs face operational disruption. This transition represents a shift we've been tracking for years through our educational content. Silver's classification is evolving from speculative commodity to strategic imperative. Government agencies are recognizing supply vulnerabilities that create national security concerns. The timing deserves analysis. Why does this appropriation emerge specifically in January 2026? Available data suggests policymakers have reviewed the same inventory reports accessible to market analysts. The United States currently imports approximately 6,400 tons of silver annually to meet industrial demand. Primary import sources include Mexico and Peru, supply chains experiencing documented disruption. Current geopolitical conditions compound these vulnerabilities. Events in Venezuela, ongoing trade tensions with China, and broader supply chain fragility have triggered strategic reassessment. Defense planners recognize a fundamental truth. If international shipping routes become compromised, domestic manufacturing capacity faces immediate constraints. This procurement program enters a market already exhibiting shortage characteristics. Consider a simplified analogy. Imagine a retail location with 10 units of essential inventory remaining. 100 consumers compete for these limited units. Suddenly, a well-funded institutional buyer enters with authorization to acquire all available supply regardless of cost. What occurs to availability and pricing for remaining market participants? Supply vanishes and price discovery becomes distorted. This $2.5 billion program functions as concentrated demand pressure within COMEX vault systems. It creates direct competition with major technology manufacturers, Apple, Samsung, Tesla, and other industrial consumers dependent on silver for manufacturing processes. Individual investors now compete against sovereign purchasing power. This is why we characterize this as unprecedented market participation. However, this participant differs fundamentally from previous major buyers. This participant establishes market rules rather than following them. The most significant implication involves self-fulfilling prophecy dynamics. When industrial manufacturers observe government agencies initiating emergency procurement, corporate supply chain managers respond predictably. They cannot afford delayed action. If Apple's procurement team believes the Department of Defense will corner available silver supply, Apple will attempt to secure inventory ahead of government purchases. We're observing the potential for bidding competition between the planet's most powerful economic entities over a diminishing pool of physical metal, experiencing accelerating depletion rates. Understanding the psychology underlying this shift proves essential. For decades, U.S. government policy involved strategic stockpile reduction. Silver reserves were systematically sold based on just-in-time global economy assumptions. Policymakers believed open market procurement would always provide necessary materials when required. Today marks that philosophy's official termination. We're witnessing the transition to just-in-case economic policy. Government agencies are acknowledging that free market mechanisms have proven insufficient for securing resources deemed critical to national survival. Therefore, direct intervention becomes policy. When governments intervene in commodity markets, the approach tends toward aggressive action rather than subtle market participation. This $2.5 billion represents an initial allocation, essentially a down payment. Once procurement begins and actual available inventory becomes apparent, authorization amounts will likely expand. Monetary policy allows printing whatever quantities prove necessary to secure physical assets. This raises the fundamental question: where will this metal originate? If procurement targets COMEX registered inventory, current reserves could drain to zero within weeks. If procurement focuses on mining operations, future supply gets locked into long-term government contracts for years ahead. Current mining operations demonstrate no spare production capacity. Existing mines face profitability challenges or grade degradation and labor disputes, particularly in Mexican operations, where strikes have curtailed production. Essentially, the United States government is announcing what effectively constitutes a hostile takeover of global silver supply infrastructure. This catalyzes the transition from bull market conditions to potential market failure scenarios. You cannot maintain a functional futures market when sovereign entities systematically acquire underlying physical assets. Short positions become untenable. Financial institutions holding naked short positions, those who've sold paper promises to millions of investors without backing physical inventory, now face this headline with growing concern. Their coverage options are severely limited. How does one cover short positions when the federal government occupies the opposite side of trades with effectively unlimited capital? The answer? You cannot. The result? Default becomes inevitable. While retail traders analyze $93 price levels on charts and draw technical trend lines, fundamental tectonic shifts are occurring beneath surface price action. Screen prices reflect yesterday's market structure, where government participation remained passive observation. That market no longer exists. We've entered an era of strategic nationalization. If your analysis concludes this is bullish, you're likely underestimating implications. Bullish markets involve participants who want to purchase assets. Strategic necessity involves participants who must purchase or face operational failure. We've transitioned from discretionary demand to non-negotiable need, and available supply cannot meet this requirement. To understand why government urgency has reached current levels, we must examine data released Friday. These numbers demonstrate vault inventory depletion occurring before government procurement even begins. We need to analyze COMEX drainage patterns and examine the mathematical impossibility of what's transpired during what should be a dormant contract month. Let's begin with a fundamental question that frames our entire analysis. If the United States government is initiating emergency procurement of $2.5 billion in silver reserves, what data have they reviewed that prompted this urgent action? Are policymakers observing a healthy, abundant market? Absolutely not. They're examining the same evidence we analyzed Friday afternoon when CME Group released their daily delivery report. The data reveals what can only be described as systematic vault depletion. We need to discuss what we're calling the COMEX death mathematics, because recent numbers aren't simply bullish. They indicate potential systemic failure. Understanding the situation's magnitude requires understanding how futures markets theoretically function. January represents what market participants call a non-delivery month. It should experience minimal activity. A transitional period between December, its major contract expiration, and March, a significant delivery cycle. Typically, you might observe a few hundred contracts standing for delivery in January, perhaps several million ounces changing hands. Think of it as routine administrative cleanup. This January tells a dramatically different story. According to official data released Friday, total deliveries for the January contract have reached 41.44 million ounces. Let me emphasize this figure: 41.44 million ounces. That represents 8,288 contracts standing for physical metal during a month that should be essentially dormant. This isn't routine settlement. This represents what financial analysts would characterize as a bank run, an enormous percentage of available inventory being extracted from the system within weeks. However, the total figure tells only partial story. To identify which institutions are actively draining inventory, we must examine the daily issuance and stops report. This ledger reveals precisely which financial institutions are selling, issuing, and which are buying, stopping. Friday's report tells a story of institutional desperation. On Friday alone, 345 delivery notices were issued. This means 345 contracts indicated we possess the silver and intend to deliver it. On the receiving end, which institution stood ready to accept every available bar? JP Morgan. Out of 345 notices, JP Morgan's house account stopped 340 contracts. Calculate that ratio. 98.5%. JP Morgan didn't merely participate in market activity, they essentially were the market. They positioned themselves to intercept virtually every delivery. Who stood on the opposite side? Which institution desperately attempted to produce the metal? Bank of America. Bank of America issued 275 of those 345 notices. This represents institutional warfare. Bank of America is hemorrhaging silver inventory. They're the institution holding naked short positions. They're frantically attempting to locate physical metal to satisfy delivery obligations. Meanwhile, JP Morgan is systematically acquiring every available ounce that enters the delivery system because they understand what I was approaching. They're aware of the $2.5 billion government procurement program. Given their political connections, they likely influence the legislation's drafting. Therefore, they're front-running United States government purchases. They're depleting COMEX systematically before federal procurement checks clear. Now let's examine what we're calling the death mathematics. Let's calculate how much time actually remains before system collapse. The most critical metric in silver markets is registered inventory. Registered designates silver that is fully warranted, immediately available, and ready for delivery against futures contracts. This is the only inventory category that matters for COMEX functionality. According to the latest reporting, the registered category has declined to approximately 120 million ounces. That sounds substantial, correct? 120 million ounces. However, compare this figure to the burn rate we just witnessed. We observed 41.4 million ounces disappear in one single month. A month that should have been quiet. If you divide 120 million by 41 million, what's the result? 2.9. That's 2.9 months, less than 90 days. That's the timeline to zero. This isn't speculation or prediction. This is basic arithmetic. If this demand rate continues, and we know it will accelerate due to government mandate, COMEX will be physically depleted by April. There will be no registered silver available for delivery. What happens when vault inventory reaches zero? What occurs when a trader stands for delivery and JP Morgan examines the vault to find it empty? This triggers a legal provision written into every futures contract as fine print. A clause most investors have never reviewed. Force majeure. Force majeure translates to act of God, unforeseeable circumstances. In practical terms, they will declare inability to fulfill delivery obligations. Instead of providing the silver you purchased, they will force cash settlement. They'll write a check for the paper price, perhaps $93, perhaps $95, and tell you the transaction is complete. But by the time they issue that check, the real street price of silver, the actual cost to acquire a physical bar, will be $200. You'll be cashed out at a loss, left holding fiat currency while physical metal prices soar. This is the trap. COMEX is structurally designed to default under extreme delivery pressure. The system functions adequately when deliveries remain small. It works when participants play the paper game. But when 8,000 contracts stand for delivery in January, when the US government enters as a buyer, the paper system breaks. Leverage destroys the mechanism. We're watching this countdown in real time. January, 41 million ounces removed. February, another substantial drain expected. March, the major delivery month where historically everyone stands for delivery. If we have 120 million ounces currently and lose another 40 million in February, we enter March with 80 million ounces. The open interest for March already indicates demand of 300 million ounces. Do you see the mathematical problem? 80 million available versus 300 million demanded. That's default. That's mathematical certainty. The market recognizes this reality. Why do you think JP Morgan is acquiring everything? Why are they stopping 340 contracts in a single day? Because they want to be holding physical inventory when the music stops. They want to hold the force majeure card, not be victimized by it. They're cornering the market in plain sight. While New York plays this dangerous game of musical chairs, another player has decided to flip the entire table. Another market has examined this death mathematics and concluded the price is fundamentally wrong. We need to shift our focus eastward. We need to discuss Shanghai, because while COMEX attempts to suppress prices to $93 to protect banking institutions, China has lost control. They attempted to manipulate the market. They attempted to halt the rally. They failed spectacularly. Let's examine the 105 on 73 reality. Let's explain why arbitrage is about to drain remaining life from the American system. This is where theoretical pricing collides with physical reality. This is where paper markets meet actual metal, and the result is a violent market dislocation that's tearing global systems apart. We concluded the previous segment by directing attention eastward. We explained that COMEX is being systematically drained, but you must understand why this drainage is occurring. It isn't simply vanishing. It's being pulled into what can only be described as a gravitational vortex that has opened on the planet's opposite side. We need to examine the Shanghai Gold Exchange. we need to discuss the $105 styles an hour and 73 price currently displayed on Chinese trading screens. For the past month, we've observed Chinese authorities attempting everything within their regulatory power to halt this rally. They're experiencing genuine concern. They observe the same shortage we're tracking, but they're attempting to manage it through administrative controls and position limits. Last week, the Shanghai Gold Exchange issued an emergency directive. They slashed position limits for traders dramatically. They reduced the maximum allowable position from 7,000 lots down to 3,000 lots. They effectively told the market, "You're purchasing too aggressively. Stop hoarding. Slow down." In normal market conditions, this type of regulatory crackdown would crash prices. It would frighten speculators away from positions. But this is not a normal market. How did pricing respond to the crackdown? Did it drop? Did it stabilize? No. It surged higher. It smashed through psychological resistance and hit $105.73. This is the ultimate signal of a broken market. When regulators attempt to apply brakes and the vehicle actually accelerates, it means the engine is no longer connected to the steering mechanism. It means demand is not speculative in nature, it's existential. Chinese industrial manufacturers, the solar panel producers who manufacture 80% of global panels, did not cease purchasing simply because government changed a regulation. They cannot stop buying. If they stop acquiring silver, their manufacturing facilities shut down. Their workforce goes home, their contracts with Western buyers get canceled. So they examined the new limits and responded by buying more aggressively. They realized that government panic confirmed the shortage. If authorities are attempting to ration the metal, it means the metal is running out. So the limit reduction order became a buy signal, and this creates the nightmare scenario for New York markets. This creates what we call the arbitrage vacuum. Right now, as we speak, you can purchase a paper contract on COMEX in New York for approximately $93. But you can sell that same physical ounce in Shanghai for 105.73 oz. That's a spread of $12,000 per ounce. That represents a risk-free guaranteed profit of nearly 13.7% simply for transporting metal from point A to point B. Do you understand what this does to global supply chains? It functions like a giant magnet. Every single bar of silver exiting a refinery in Switzerland, or a mine in Mexico, or a vault in London examines those two prices. Where will you ship your metal? Will you send it to New York to sell for 93, or will you put it on a plane to Shanghai to sell for $105.73? The answer is obvious. Metal flows to the highest bidder. Metal flows east. This explains why COMEX inventories are collapsing. This is why JP Morgan is stopping every single delivery notice. They're attempting to construct a dam to prevent the river from flowing to sea, but the dam is leaking. The arbitrage pressure is too strong. As long as that 12+ gap exists, COMEX will continue bleeding until it's dry. New York is effectively becoming a discount retailer for the rest of the world. The only mathematical solution to stop the bleeding is for New York prices to rise. Prices must rise to meet Shanghai. They must gap up by $12 overnight just to reach parity. And that assumes Shanghai prices remain static. But Shanghai is not standing still. Shanghai is moving toward $110, then $120. The West is chasing a ghost it cannot catch. While we're observing this titanic battle between nations, while we're watching the US government enter the arena and China break through regulatory limits, there's another casualty in this conflict. There's another market sector quietly suffocating, unnoticed by institutional giants. We need to examine the retail sector. We need to look at the individual investor who simply wants to purchase a few coins for family protection. Because if you think the shortage is only affecting billion-dollar institutional vaults, you're fundamentally mistaken. The contagion has officially reached Main Street, and we have documentary evidence to prove it. We need to discuss APMEX. We need to examine the largest online bullion dealer in the United States and the significant operational failure that just occurred inside their private minting operation. Because if you're planning to purchase silver next week, you might discover the store has already closed. Let's examine the evidence on the ground. Let's review the official communication. This is where the narrative stops being about numbers on screens and starts being about physical reality in your hands. We've discussed the United States government. We've analyzed JP Morgan's actions. We've examined the Shanghai Gold Exchange. But you're probably thinking, okay, but I can still go online and buy a coin, right? The retail shop is still operating, right? Incorrect. The shop isn't just closed. The manufacturing facility behind the shop has just experienced catastrophic failure. We need to discuss the revelation that emerged this weekend from the largest online bullion dealer in the United States. We need to talk about APMEX, and we need to examine the letter signed by CEO Ken Lewis that is currently circulating in the private email inboxes of major clients. This letter is not a marketing communication. It's a confession of catastrophic failure in the retail supply chain. According to the internal memorandum, APMEX is currently facing a demand surge that is 4 times normal volume. They're experiencing the 3rd busiest week in the entire company history. Normally, that would represent positive news for a business, but in the physical silver market, excessive demand becomes a death sentence if you cannot secure supply. Here's the critical part of the correspondence. Ken Lewis acknowledged a significant development, corporate language for disaster, at their private mint. You need to understand that APMEX relies on their own branded products for roughly 90% of their bar and round sales. They don't just resell eagles, they manufacture their own products to keep premiums lower and volume higher. But the letter reveals that due to mechanical failure or supply issues, they're being deliberately vague on specifics, their production capacity has effectively collapsed by 50% overnight. They have half the metal they expected to possess, and they have 400% more customers attempting to purchase it. Calculate that equation. Demand is up 400%. Supply is down 50%. That's a recipe for total market freeze. And APMEX recognizes this. They know they cannot fulfill orders. So what did they implement? Did they simply raise prices? No, they did something far more ominous. They built a barrier to entry. As of this weekend, APMEX has instituted a mandatory $500 order minimum. This is the velvet rope being positioned in front of the lifeboat. If you're a small investor, if you are the person who saves $50 weekly to buy one Silver Eagle or one generic round, you're gone. You're locked out. They've effectively told the small buyer, we do not want your business. We cannot handle your volume. You're too small to prioritize. They're prioritizing large buyers. They're prioritizing bulk purchasers because they don't have sufficient inventory to waste operational capacity shipping single ounces. This is exactly what we predicted in our Stage 5 analysis. We told you that eventually the market would bifurcate. We explained that dealers would stop selling to the general public and start rationing metal. This $500 minimum represents the first step. Next week it becomes $1,000, then it becomes $5,000, and then the website simply displays sold out. This isn't a temporary glitch. This is systemic failure of the just-in-time delivery model. APMEX is the canary in the coal mine. If the biggest dealer in America, the one with the deepest financial resources and the best industry connections, cannot keep their mint operational and must ban small orders, what do you think is happening to the local coin shop down the street? They're empty. They're ghost towns. And you must connect this back to the macro picture. Why is the mint failing? Why can't they obtain raw silver grain to cast bars? Because JP Morgan is stopping 340 contracts on COMEX. Because arbitrage is sucking metal to Shanghai. Because the US government is preparing to purchase $2.5 billion worth of material. There's no silver remaining for retail mints. The feedstock is gone. So APMEX is essentially communicating that the river has dried up. And this creates a panic loop. When people hear they cannot buy, they want to buy even more intensely. The people who were waiting for a pullback are now realizing that price is irrelevant if the buy button is disabled. So they're scraping together $500. They're borrowing funds. They're rushing the gate. And this rush will only accelerate inventory collapse. This is the definition of mint failure. It's not just machinery breaking down. It's the supply chain snapping under the weight of a failing currency system. The retail investor is officially being forced out of the market. The window is closing on your access right now, but if you think the retail situation is severe, wait until you see the timeline for institutional collapse. Wait until you observe how this retail freeze interacts with the government buy program to trigger the ultimate legal escape mechanism for banking institutions. We need to discuss April. We need to explain why the calendar itself is your adversary. We need to talk about the inevitable force majeure. This brings us to the most dangerous intersection in financial market history. We've mapped the battlefield comprehensively. On one side, we have the retail freeze, where dealers like APMEX are physically unable to mint coins and are locking out small buyers. On the other side, we have institutional warfare, where JP Morgan is battling Bank of America for the last remaining silver in the vault. And hovering above it all is what we're calling the new Death Star, the United States government with its $2.5 billion purchase order. Now we must place these elements on a calendar. We must examine the timeline because the mathematics do not permit this situation to continue indefinitely. We're not looking at a crisis that will unfold in 2027. We're examining a crisis with a specific expiration date, and that date is April 2026. Why April? Because of the brutal arithmetic of COMEX delivery schedules. Right now in January, a month that usually sees almost zero activity, we've lost 41 million ounces. February is another non-delivery month, but given the panic we're observing, we can conservatively estimate another 30 to 40 million ounces leaving the vault as industrial users scramble to front-run government procurement. That brings registered inventory down from 120 million to roughly 80 million ounces by the time we reach March 1st. And March is the major delivery cycle. March is traditionally the month where the largest contracts expire. If January, a quiet month, took 40 million ounces, what will March demand? The open interest for March is already massive. The demand is already locked in. If holders of those March contracts stand for delivery, and they will because the arbitrage to Shanghai is 12 plus, they will demand 80 million, 100 million, possibly more ounces. They will demand more metal than exists in the registered category. This is the mathematical wall. You cannot deliver what you do not physically possess. And when the vault hits effective zero, which occurs when the only remaining metal belongs to clients who refuse to sell at any price, the exchange has only one option remaining. They must declare force majeure. Now, most people hear that term and think it sounds like legal jargon. They think it doesn't apply to them, but force majeure is the trapdoor waiting beneath your feet. It's the contractual clause that states, if we cannot deliver the metal due to circumstances beyond our control, such as government seizure or supply collapse, we reserve the right to settle your contract in cash. Read that again. Settle in cash. This is the nightmare scenario. Imagine you purchased a futures contract at $93 because you wanted to secure 5,000 ounces of silver. You executed proper analysis. You identified the trend. You bought the dip. You held the contract. But when April arrives and you request your bars, COMEX responds, sorry, we're out, but here's a check for $93 per ounce. You receive your fiat currency back, but what is the price of real silver in April? By April, with vaults empty and government panic buying, the price of a physical bar on the street, if you can even locate one, will likely be $200, possibly $300. So COMEX gives you $93 and the real price is $200. You've technically been made whole in paper terms, but in reality, you've been wiped out. You missed the appreciation because you held a ticket for a seat that didn't exist. And do not think for a second that the government will protect you. The $2.5 billion buy program is the catalyst for this default. The government wants the metal. They do not want you to have it. If COMEX declares force majeure, it actually helps government objectives. It clears out speculators. It forces paper holders out of the market. It leaves remaining physical supply available for the Department of Defense to acquire under the Defense Production Act. This is why we characterize this as a hostile takeover. The government and banking institutions are effectively coordinating to close the casino and confiscate the chips. JP Morgan takes physical inventory. The government takes physical inventory. And the retail investor gets a check that loses purchasing power due to inflation. This is the April event. It's the moment where the price of paper and the price of physical silver divorce permanently. We're already observing the fractures with the 12+ spread in Shanghai. We're seeing the cracks with the $500 minimum at APMEX. But in April, the crack becomes a canyon. There will be no price discovery anymore. There will be a reference price on CNBC stating silver is $100, and there will be a real price on secondary markets indicating silver is unobtainable. You do not want to be holding paper when that split occurs. You do not want to be the person waving a check at an empty vault. So the timeline is established. We have less than 90 days before the primary delivery cycle breaks the exchanges back. We have JP Morgan aggressively cornering the float in January to prepare for this exact moment. And we have the United States government entering the market with effectively unlimited capital to accelerate the drain. The window is not closing. The window is practically shut. There's only a sliver of light remaining. And that leads us to the final educational conclusion. What should you understand on Monday, January 19th? How should you position yourself in front of a steamroller moving at maximum speed? You don't trade based on speculation. You don't gamble on price predictions. You secure the asset. Let's conclude this analysis. Let's provide the final educational summary for the week, because every hour of delay is an hour closer to force majeure. Here is the verdict based on available evidence. We have presented the death mathematics of COMEX. We have shown you the confession letter from APMEX. We have demonstrated the 12+ arbitrage gap in Shanghai. And most importantly, we have introduced you to the new institutional participant that has just entered the ocean, the United States government with its $2.5 billion mandate to secure physical inventory. The picture is not complicated. It is terrifyingly simple. We are witnessing a simultaneous supply shock and demand shock hitting a market that is already operating on minimal reserves. We are observing the perfect storm that our educational content has been warning about for years, and it is all converging on a single point in time, spring 2026. You need to understand that markets like this do not reverse. When the United States government determines that a commodity is a matter of national security, the price trajectory does not turn downward. When JP Morgan decides to corner the market and stops 98% of deliveries, inventory does not magically reappear. And when the largest retail mint in America cuts production by 50% due to a critical failure, coins do not simply show up on shelves next week. The trend is locked in. The destination is zero available inventory. The destination is a world where silver is no longer something you can purchase with a button click. It becomes something you must compete for. It becomes something requiring insider connections to acquire. It becomes unobtainable. So what is your strategy? What do you do this Monday morning while the rest of the market remains unaware? Do not look at charts and wait for a pullback. Waiting for a pullback to $85 when the Shanghai price is 125 or 73 is irrational. It is equivalent to waiting for a discount on water while your house burns. The price on the screen is disconnected from reality. It is a mechanism designed to make you hesitate. It is designed to keep you on the sidelines while JP Morgan and the Department of Defense drain the vault. Do not fall for this trap. If you can locate physical metal, if you can find a dealer that still maintains inventory and will ship to you, consider securing it. Pay the premium. Pay the shipping. Pay whatever they request, because the premium you pay today is the cost of admission to the lifeboat. Next month, that premium might be 50%. In April, when force majeure hits, that premium might become infinite, because there will be no metal for sale at any price. We are witnessing the end of the paper era. We are observing the death of the illusion that you can print wealth indefinitely. The United States government understands this. That is why they are buying. The Chinese understand this. That is why they are hoarding. Major institutions understand this. That is why they are repositioning. The only person who doesn't understand this is the individual watching mainstream financial media who thinks silver is just a volatile commodity. Do not be that person. Do not be the individual who holds a paper contract and gets settled in cash when currency devaluation accelerates. Be the person who holds the physical bar. Be the person who holds the only asset with no counterparty risk, no printing press, and no centralized control. This is your final educational warning for the month of January. The 41 million ounce drain was the initial signal. The Apimex letter was the confirmation. And the government buy program is the catalyst. The event is here. The window is closed. If you are positioned, you are positioned. If you are not, the educational data suggests significant challenges ahead. This concludes today's market education. The institutional buyer has arrived. The vault is approaching depletion.